First, we would like to say thank you to Sir Asui, the lecturer for this course KM00403, Management and Accounting for Engineers. So before we proceed to assignment 2 presentation, I would like to introduce my fellow group mates. We are from Group 3 and our group consists of 4 members, which include myself, Aswan, Stanley, Ahmad, Anwar, and Aziatul Aznita. So this assignment will consist of 2 parts, which is part A and part B. Part A can be divided to several subtopics, and part B will consist of 3 sets of questions. So for part A, we need to provide a discussion for certain subtopics, which is job order costing, process costing, and capital budgeting. So for my part, I will briefly explain the purpose of job order costing. So basically, the purpose of job order costing is you want to assign cost to a job or a batch of goods. Example of jobs is such as a Boeing company, they want to manufacture a jet. Or an example of batch of goods is like a local shops. They want to print a set number of wedding card for a wedding ceremony. So each job has its own unique features, or in other words, its own unique characteristics, as shown in figure below. As you can see, there are 2 jobs here, which is animated films and action thriller. So each job has its own characteristic. For example, like computer programmers, musical composers, actors, and stunt people. So overall, the objective of this job order costing method is you want to compute costs for each job. So this job order costing mechanism can be further explained based on the example given here. So the first step is we need to accumulate the manufacturing cost, which is in this case is the raw material cost, the factory labor cost, and manufacturing overhead cost. After we accumulate this cost, then we assign this cost to a specific jobs, which is in this case the work in process. So we assign this cost to the work in process inventory. So 4, 5, and 6 will be transferred to work in process inventory. Then, after the assignment process is completed, we assign these complete jobs into finished good inventories, which is shown in number 7. Then, when a specific item is sold, this cost of sold item will be transferred into the cost of goods sold.
Hello, my name is Aziatul Aznita and I will discuss regarding the process costing. So according to the introduction of management accounting, the process costing is a method of allocating a cost of a large number of nearly identical products. There are 3 basic forms of process costing that can be employed in various scenarios. The first one is the weighted average cost, which calculated by dividing the cost of available items by the number of products available for sale, resulting in an average cost per unit. Next is the standard cost, where the results are compared to the actual expenditure incurred and the difference is charged to difference variance account. And then the last one is the first in first out, where the value of the first product purchased are the first one sold. Despite of having 3 types of methods, process costing have 5 basic steps as shown. For better understanding regarding the steps, we will look into this example. The forming department of Oak by Wooden Toys had no beginning inventory and completely manufactured 25,000 identical units of marionette during April, leaving no ending inventory. And its cost that month is shown. Since there is no ending inventory, the unit cost of goods completed is simply $130,000 divided by 25,000 units, which is $5.20. And itemization would show as the following. There's 2,000 units which is still in process at the end of April. The company have determined that they only receive 40% of the conversion results. Now to solve this problem, for the first step is the physical unit where the total 25,000 are stated, but not all of these are counted in the following department output. It is stated in the equivalent unit. To obtain that, the physical unit is multiplied to the percent of completion, which is 40% of the conversion. Next is to summarize the total cost to account for, which is the cost applied to work in process. For the fourth step, it is to calculate the cost per equivalent unit by dividing the 2 categories of total cost by the appropriate measures of equivalent units. And then lastly, this unit cost is used to apply the cost products. The finished units are complete in terms of both direct materials and conversion costs. Thus, it can be simply multiplied the full unit cost times the number of completed units to determine the cost. The physical units is ending work in process inventory are fully completed in terms of direct materials. Thus, the conversion cost applied to work in process to obtain the total cost of ending inventory.
Greeting everyone, my name is Ahmad Anwar. Today I will be presenting capital budgeting and its two project is two method, which is net present value and internal rate of return. So what is capital budgeting? It is described as an investment decision making for a project that will affect the financial result for more than a year. So the capital budgeting is generally used for new equipment acquirement, replacement of asset, expansion of facilities, investment in employee training, and lastly, the expenditure to improve process efficiency. So the capital budgeting is a method for assessing the financial viability of a capital across the lifespan of the investment by focusing on identifying cash inflow and outflow. So we have the model for capital budgeting, which is discounted cash flow. This model compares the present value cash outflow with the predicted future cash flow by converting them into present value based on the theory of compounding interest. Net present value and internal rate of return are most common approach to make the investment decision. To assess the value of the capital investment, the timing of the future cash flow it must be considered and converted into corresponding value, that is the value of today future cash flow. What is NPV? NPV is a discounted cash flow approach that calculates the present value of all expected future cash flow by using an interest rate called the required rate of return or discount rate. The discount rate reflects the opportunity cost of the capital that will be mobilized, which then increase the estimate riskiness of innovation opportunity. So the positive NPV means the present value of a future cash flow will exceed the value of investment, whereas the negative NPV means the value of investment will exceed the present value of future cash flow. To apply the NPV method, there are three steps. First, using first step is identify the amount and timing of relevant expected cash inflow and outflow. Second step is find the present value of each expected cash flow using present value table. And last step is to sum all the individual present value. But the NPV can also be determined by using formulation on the screen. So the advantage of NPV is time value of money is given more importance, and project profitability and risk factor are given high priorities. And the disadvantage for the NPV is it might not give an accurate decision when there are two or more of unequal project lifespan. And last disadvantage for NPV is it does not provide an accurate answer of which period of time that a positive NPV is achieved. So next method is internal rate of return or IRR. IRR method determines the discount rate at which equates the aggregate present value of cash inflow after tax with the aggregate present value of cash outflow of a project. This method is ideal to analyze capital budgeting for better understanding and comparing its potential rate of annual return over time. However, IRR cannot be easily calculated analytically and must be calculated iteratively through trial and error. So if IRR is lesser than discount rate, then the NPV is lesser than zero, the proposed project should be rejected. However, if IRR is greater than discount rate, the NPV must be greater than zero, so the project can be accepted. So the advantage for IRR is it is easy to compare to the required cost of capital since it is expressed in percentage. For disadvantage for IRR is it is difficult to make comparison if the discount rate changes every year.
I am Stanley and I will present for part B in assignment 2. So for question 1, suppose I'm a loan officer for a bank and I need to ponder various proposals for repayment. So for part A here, we have a lump sum of 250,000 ringgit in 5 years. So we will need to determine how much money we can lend out if the required rate of return is, in the first situation, 8% compounded annually, and second situation, 12% compounded annually. So using the formula PV equals to S multiplies with 1 over 1 plus I power with n, whereby S is the amount received or paid, I is the interest rate per period, and n is the periods, we can actually determine the money we can lend out. Therefore, by substituting the relevant values into the equation, for the first situation, the PV equals to 170,000 145 ringgit and 80 cents, while in the second situation, the PV is 141,856 ringgit and 71 cents. So in part B here, the situation is similar, but assume the interest rates are compounded semi-annually. Since the interest rates are compounded semi-annually, the interest rate is actually divided by half while the periods are increased twice. Therefore, in the first situation here, the PV changes to 168,891 ringgit and 4 cents, while in the second situation, the PV becomes 139,598 ringgit and 69 cents. So, for part C, to determine the PV, we firstly have to determine the annuity factors, which can be calculated using the expression shown here. Therefore, at 8% rate in 5 years, the annuity factors is found out to be 3.9927, and the PV is found out to be 199,635 ringgit. While at 12% rate in 5 years, the annuity factors is found out to be 3.6048, and therefore the PV is 180,240 ringgit. So for question 2, the company is considering an investment in a machine that costs 36,048 ringgit and will result in cash savings of 10,000 ringgit per year for 5 years, and the company's cost of capital is 10%. So for part A, we need to compute the project's NPV at 10%, 12% and 14%. We need to use the formula of NPV equals to PV minus cash outflow. Therefore, at 10% rate in 5 years, in the first situation, we would first determine the annuity factors to be 3.7908, and subsequently we will find out the PV to be 37,908 ringgit, and we will result the NPV in 1,860 ringgit. And for second situation, at 12% rate in 5 years, the annuity factors is found to be 3.0648, and therefore the PV is actually 36,048 ringgit, and therefore we will find that the NPV is actually equals to 0. While for the third situation, at 14% rate in 5 years, the annuity factors is found to be 3.4331, and the PV is 34,331 ringgit, and therefore results the NPV to be a negative value, which is 1,717 ringgit. For question 2b, we will need to compute the project's IRR, which is the internal rate of return. Since IRR is the rate that max NPV equals to 0, to determine IRR, we have to determine the annuity factors first, and the annuity factors can be expressed as cash outflow divided by savings, which determined to be 3.6048. So refer to the appendix. The corresponding IRR for the PV is actually 12%. For question 2c, suppose the company uses the NPV model, would it accept the project? Why or why not? So at 10% and 12% discount rate, the company will opt for NPV method since the NPVs are positive for both cases respectively. However, at 14% discount rate, the company will not opt for NPV method since the NPV is negative. And for 2D, suppose the company uses the IRR model, would it accept the project? Why or why not? Since IRR is larger than the required rate of return, the project should be accepted. For question 3, the company is considering 2 new machines that should produce considerable cost saving in the assembly operations. The cost of each machine is 40,000 ringgit, and neither is expected to have a salvage value at the end of a 4 years useful life. The required rate of return is 12%, and the company prefers the project returns its initial outlay within the first half of the project's life. And the figure here actually shows the annual after-tax cash savings for each machine. And therefore, for question 3a, we need to compute the payback period for machine A and machine B. So we will need to deduct the values for each year. And therefore, for machine A, the payback period is 2 years plus 4,000 over 5,000 times a year. So we will get the payback period to be 2.8 years. And for machine B, the payback period is 2 years. For question 3b, we need to compute the net present value for each machine. And to determine the net present value, the NPV is calculated using the expression shown here, where the NPV equals to the sum of CF over 1 plus I power with n minus with the initial investment